You took everything from me.
I don't even know who you are.
You will.
The investment landscape is always changing. One day, Bitcoin is a trend, then it tanks. The next day, it's travel stocks. Then all of a sudden, Tesla's on the rise and it's a new talk of the town. So what are you supposed to do in the face of such uncertainty? When things change so quickly that you no longer know whether they are a good investment? The answer lies in following a set of principles which you can use regardless of what's going on in the current economic climate. Knowing what to do or how to act during these times can be the difference between success and failure. That's why following principles is so important. So without further ado, here's my top 6 investing principles or rules I use in this volatile and unpredictable world of investing. Number 1. Avoid emotional investing. Emotions may serve you well in your personal life, but it has no place in your investing decisions. Investments should be based off logic rather than emotion. Investing based on emotions of greed or FOMO is the main reason why so many people get burnt. Let me make this clear. Emotions don't make you money. Having a sound intellectual framework for making decisions, combined with an ability to keep emotions in check, does. But investing without emotions is easier said than done. Intellectually, you get it. Emotion hurts your returns, but that doesn't make it any easier to resist them. While fear and panic come naturally during volatile times, you can control how you react to these emotions. You can learn how to tune out irrelevant information and noise, and to resist the urge to follow the crowd. If you're steering your investments solely on herd mentality, it's going to lead to poor decision making, and sooner or later, you're bound to make mistakes. That's why you need to focus on thoroughly researching the businesses you're considering, and not let exterior noise cloud your judgment. You need to be able to think independently and rationally. Investing decisions shouldn't be taken lightly, and you should make sure you know what you're doing and what you should be looking at before buying any stock. If you're unsure, stick to index funds or like and subscribe to my videos. Number 2. Never invest in a business you don't understand. A very common mistake for newer investors is that they approach investing with the sole intention to make it or break it. They chase the hype and jump into stocks that they have no idea about. Then if things go badly, they get discouraged from ever touching the stock market again. So you really need to focus on the company behind the stock. Know what you own and why you own it. Thoroughly research everything you can about it. What do they do? What do the fundamentals of the business tell you? What are the competitive aspects of the business, and what sort of challenges do they face? The more you know about a company, the more informed your choices will be. Many successful investors stay within their circle of competence. Everyone's circle of competence is different because everyone's skills, experiences, and understanding is different. You don't have to be an expert on everything. Sticking to what you know is perfectly fine. If a business is outside your circle of competence, you can skip it altogether, or expand your circle by learning about that business and industry until you thoroughly understand it. In investing, knowing what you know is important, but knowing what you don't know is equally important. Number 3 is probably the best investment you can ever make. It is to invest in yourself. Invest in yourself as much as you can. You have all kinds of potential, and if you give yourself enough time, energy, and space to grow, you're going to create amazing results that nobody can take away from you. It's the best thing you can do and provides one of the best return on investments you can make in your life. Whether it's in learning a new skill, developing yourself personally or professionally, or taking care of your health. There's so many ways. Let's say you have $1,000 to invest and you can achieve a 10% annual return from the stock market, giving you an additional $100 per year.
You guys are getting paid?
That's great and all, but let's say instead you use that money to improve your education and build your knowledge by reading books and attending seminars or workshops. Suddenly, you might be able to get that 10k pay rise from your job or start that side hustle that you've always wanted to do. Your education does not end after you finish school. Your education continues until the day you die. You can have all kinds of things happen, and that's a 10 times return, a 10 bagger. That's why investing in yourself is so powerful. Set yourself up to win. Make a commitment to yourself. It's the best investment you can possibly make, and it will make all the difference. Number 4, don't try to time the stock market. No one can predict the stock market consistently. If they could, they would all be billionaires. So why are the markets so hard to predict? In order to answer this question, you have to understand that the markets are driven by supply and demand, with an endless number of factors influencing it. You might be able to factor in all known factors, but the vast majority of unknown factors are literally impossible to account for. Oh, and Mr. Market sometimes acts on pure irrationality, so good luck with that too. In a quantitative analysis of investor behavior report by Dauber, it showed that if an investor remained fully invested in the S&P 500's index between 1995 and 2014, they would have earned a 9.85% annualized return. However, if they missed only 10 of the best days in the market, the return would have only been 5.1%. This shows that your return on investment would be nearly half if you were out of the market for only 10 of the best days. Another study by William Sharp on the likely gains from market timing concluded that an investor employing a market timing strategy had to be correct 74% of the time to beat a passive index fund tracking a benchmark. Morningstar found similar results, where an investor had to be correct 70% of the time to beat a buy and hold strategy. That's why investors who try to time entrances and exits often tend to underperform investors who simply remain invested. Number 5 ties in with the previous point of not trying to time the market. It is to use dollar cost averaging. Dollar cost averaging is a strategy where you divide multiple smaller investments of equal amounts over regular intervals. The purpose of this is to reduce the overall risk of making one lump sum investment that is poorly timed in terms of share pricing. By making periodic investments, dollar cost averaging allows you to reduce the overall impact of volatility. The pros of this are that it removes the emotional aspect of investing and minimizes the effects of bad timing. The cons of this are that you will no longer be buying at a cheap price, but at an average price. Also, since markets tend to rise over time, if you invested a lump sum earlier, it's likely to do better than smaller amounts invested over a period of time. Dollar cost averaging is best applied in a market downturn because it reduces the average cost of shares bought. However, it can be applied in any market condition, and generally staying invested has often resulted in the best long-term performance returns. Number 6. Practice patience. You would have heard this phrase a million times by now. It's time in the market beats timing the market. Good investing has little to do with how smart you are, and a lot to do with how long you stay invested for. You need to have a long-term mindset to reap the benefits of compound interest, to give you the best chance of accumulating wealth. Investing is one of the few fields where the less you do, the better you're likely to perform. Time and time again, you'll see people moving in and out of assets which could be detrimental to their portfolio and long-term investment goals. The big money is not in the buying and selling, but in the waiting. Investing is relatively straightforward. It's the implementation that's difficult. Long-term investing just simply works. Buy good companies and hold them for a long time. That's it. That's what we do. So let's recap my 6 rules of investing. Avoid emotional investing. Never invest in a business you don't understand. Invest in yourself. Don't try to time the stock market. Use dollar cost averaging. And practice patience. In times of market uncertainty, it is more important than ever to avoid emotion-fueled investing and making decisions based on others' opinions. Remember to stay focused on the fundamentals and have a clear plan based on reasoning and analysis to guide your investment decisions. Stick to your key investment principles, stay rational, and don't give in to your emotions. Movements in the market may make you feel uncomfortable or emotional, but if you have the discipline to remain calm and logical, you are likely to be better off. Few will be able to do so, but those few will be the ones who make the high returns.